Okay, so now where does the bad debt expense estimate come from? So again, we need to figure out what that amount was. We were just told it was $1,000 here, right? We just again came up with this number, but where does it come from? There's three different ways that we can estimate it: the percentage of sales, percent of receivables, and aging of receivables. What you're basically going to do is use historical information from your company, from your industry, and see how the economy is doing. There's probably some accountant, their whole job is to do these estimates, okay? Because this is a involved process, but it's basically going to be based on past experience, um, who your current customers are. There's going to be some credit analysis, and you're going to come up with some estimate of how much total you're going to not be able to collect based on what your accounts receivable are at that moment. Okay, um, and you're going to either have that as some percentage of your sales, some percentage of the ending balance of account receivable, or this aging of receivables is a little more complicated. Okay, so we'll look at that in a second. But let's talk about these other two. So percentage of sales, basically, you're going to take some percentage of how much revenue you generated, and that percentage is going to be based on what I talked about: historical analysis, trend analysis, factoring in the economic factors. You're going to come up with some percentage, okay? And then you're going to apply that percentage to how much you generated in sales. And that's going to be how much bad debt expense you're going to take. So this is called an income statement approach, because you don't care about your ending account receivable balance. You actually just look at how much sales you generated. And it's going to be it's going to state whether it's a percentage of all sales or just credit sales. Okay, so it's going to be like 5%. 5% of what? 5%, it's going to state, is it 5% of credit sales? Then you'll see how much you generate in credit sales and multiply that by 5%. If it's 5% of all sales, you'll multiply your total revenue by 5% to get the bad debt expense. So just make sure that you know what the percent is applied to. You have to read carefully and make sure you're clear on what revenue it's talking about, because it could be, if you have $1 million in revenue, maybe 700K of that was cash sales and only 300K was credit sales. And so if it was 5% of credit sales, you'd only multiply 5% by the 300,000, not by the full million. Okay. But if it was 5% of all sales, you would multiply it by this million. Okay. So the other problem with this is that it doesn't self-correct. Okay. We're going to see with the other two methods, they will get trued up every period. Okay. This method, you can keep having structural errors until you're going to hit a point where it's like your allowance for bad debt is basically a debit balance. That's when you've screwed up beyond being correctable. Okay, so again, your allowance for bad debt, it should always be a credit balance because it's a contra account. So if you keep making structural mistakes and it eventually becomes a debit balance, your accounting for bad debts cannot continue. You have to at least get it to zero. Okay, you cannot allow allowance for bad debt to be a debit balance. So at that point, if you're using percentage of sales, you'll have to make probably a large bad debt expense correcting entry. Okay, to not only make up for all the previous periods you've been underestimating, but to also get a credit balance back into bad debt expense. So that's what a lot of businesses will do. They'll underestimate the allowance for this kind of stuff, and then some new CEO's taken over, and it's like not your problem anymore. And then they'll have to take a really big adjusting entry and a big expense, much bigger than they would have had to if they had just been doing it correctly or honestly up to that point. So this is very common in kind of corporate accounting too, to pass the buck to the next CEO or the next managers. Okay, because that boosts the profit in the period that you're CEO. If you can boost the profit and have your stock options worth more, you're going to do that, and then screw the other guy. So in this example, uh, past experience suggests that 0.5% of credit sales, okay, so this is again very clearly written here, will be uncollectible. And the credit sales are $60,000. So the amount of bad debt expense is going to be this 60,000 times this 0.5%. And this gives us how much bad debt expense to take. Okay, so it's a very simple uh, kind of method. The hard part is coming up with this. But again, this class, you're just going to be told that this is a whole large analysis to come up with this 0.5%. Like, where did that come from? That's the next question. And that is like, much more complicated. You have to see the history of the company, all their collectibles. They'll look back in time for the last 5 years and seeing how much they've kind of had as bad debt expense. And they're going to come up with this 0.5 and assume that's going to be the projected forward-looking bad debt expense. Okay, so this 0.5% there's a lot built into that, but we're not going to really talk about that. It's a much more complicated analysis. Okay, but for our purposes, we're told this 0.5%. We multiply it by our credit sales, and then we do this adjusting entry. Okay, so there's going to be some existing balance, unless it's the first year of our business. So allowance for bad debt. Maybe we had, $1,000 as the unadjusted balance at the end of the year. Now we have this adjusting entry. We're going to add another 300 to it. So now we have 1,300. So now our piggy bank is set up for the next period. Okay. And then of course we'll have some write-offs that happen. This piggy bank will get drawn down. We'll have some new at the end of that year. Maybe we had, I don't know, 1,100 in write-offs that happened during the year at various times. So the ending balance is now $200. And then we'll have another adjusting entry that happens at the end of that year, and it'll just keep rolling down. But again, as I mentioned, there's no self-correcting thing, because this $300 is not based on the account receivables. It's based on the sales that happen in that period. So if we're overestimating, this thing can keep growing. Okay, so let's do a slightly different example here. If this, instead of 1,100, was only 100, okay, then this would be 1,200 instead. And then maybe we have another $500 adjusting entry, and it's 1,700 now. So you can see it's growing. It started at 1,000, it went to 300, 1,300, it went to 1,700 here, and it can keep growing like this. Okay. In this case, we're overestimating how much bad debt expense we have. Okay. And so this method is not correcting that. It can just grow indefinitely. Okay. So that's one big flaw of this method. Okay. It's not targeting a bad debt, like a bad debt piggy bank. The piggy bank is like a secondary effect of the estimate. Okay. So you're going to see in the next methods that actually, it's going to target how much the piggy bank should be every period. That's a maybe more accurate way. But for now, let's just see again to clarify. So we have this as our starting balance. We have these two write-offs here at random times in the year. Our unadjusted balance at the end of the year is this. We then have the adjusting entry, right? We have this adjusting entry here that's adding some balance to our piggy bank. And this is our adjusted balance at the end of the year. And then, of course, we'll have some more write-offs. We'll have some new balance. We'll do another adjusting entry, and it'll just keep rolling. Let's change one thing, though, okay? If this November 22nd write-off was 1,300, we change this to 1,300, What is this going to be now? What is the unadjusted balance? I'm trying to get this to be 0. Okay, so we would have had to make this 1,000. This is 1,000. This is going to be 0. Everyone agree? This adjusting entry, as I said, it doesn't matter. It didn't really care about this if it was 800 or 1,000. This $300 was based, again, on this calculation, based on our sales from the period. Okay, so now uh, this would be 0, this would be 300, and this would just be 300. Okay, so our piggy bank is smaller now, right? In the next period, maybe it's going to be not enough to cover all the write-downs. Okay, so now if this was even larger, this was even larger, let's say it was 1,600. This is now 2,100, 15. So this is a $600 uh, debit balance. This adjusting entry is unchanged. And so we're going to end up with the invalid kind of allowance for bad debt. We would have a $300 credit balance, or sorry, debit balance. So this would be wrong. We'd have to do some large adjusting entry here. We could not just leave this. We'd have to fix this. Okay, so this is, again, I'm trying to illustrate the drawback of this percentage of sales method. It's not always going to give you like if you have some structural problems with your estimating, it's gonna at some point blow up. Okay, which is what happened in this case. If I had basically too much write down for how much I had in the piggy bank.